Let's bring in Vital Knowledge founder Adam Crisafulli. Adam, great to have you on. The S&P, it looks like finishing the day here at 45.79, down about 0.2%. It keeps rejecting that 4,600 level. Are you surprised?
Yeah, I think there's definitely a valuation issue in the market right now, both on an absolute basis, just looking at P's on an absolute basis, but especially relative to yields, especially on a day like today where you saw yields really jump. So, in my mind, I think valuation is really the only major obstacle in the near term to this market. But fundamental news flow remains quite supportive. And I think today was quite interesting how well stocks absorbed the move in rates. And I think part of that comes down to the shape of the curve. So you're seeing a steepening out of the curve, reflective of a lot of the Goldilocks data that stocks have been responding to now for the last several weeks. And so I think obviously higher yields exacerbates the valuation issue with equities, but I think so long as the curve continues to steepen out, so long as you see supportive news flow on the data front, on the earnings front, I think the market will stay relatively bid. It's a question of how much higher can it get from here? Because like I said, there are definitely valuation impediments.
Yeah, we had the Fed's Bostic on the tape not that long ago talking about that if the economy evolves as he expects, that this would be a comfortable advocating for, oh no, that's not the line I'm looking at. I'm looking at data that's consistent with an orderly slowdown, which sort of speaks to this Goldilocks data that we've been getting so far. Look no further than ISM manufacturing this morning, JOLTS reading today as well. Any reason to believe that could change, especially when you do see things like credit tightening per the survey we got yesterday?
Yeah, there's definitely obviously still the risk of a slowdown for a variety of different reasons. You can argue that consumers have been sheltered from rate hikes. You're seeing that in housing where a lot of mortgage rates are at far below current market levels. For a variety of reasons, you could say that there definitely are a lot of economic risks on the horizon as excess savings get exhausted, et cetera. But your bigger risk is that you see an acceleration in growth, like you see with Caterpillar today, the biggest cyclical stock on the planet, hitting all-time highs up 8% on earnings. That suggests that there is an acceleration going on in the underlying economy. And the risk then is that pushes yields higher, and that forces possibly the Fed to even doing more. So I think that's kind of, at this point in time at least, your risk is more, I think, that you don't have the type of disinflationary outcome that the Fed's really looking for, in which case central banks have to kind of reassess their outlook over the coming months.
Adam, looking at some of these post-earnings reactions, most recently Uber, did pretty well, though it was a top-line miss, and it was down significantly. Microsoft did pretty well several days ago. It's lower. Is the bar just really high? How much of it's valuation? How much of it might be sentiment? As well in combination with that as we look forward to some more of these earnings coming out today?
Yeah, definitely. Especially for tech, you have a very high bar with some of these stocks. Obviously, tech has been leading the market higher for the last several months. So the bar has been higher for these names. I think, too, for a company like an Uber or Microsoft, you bring up two great examples. Microsoft reports a fully GAAP EPS number where pretty much everything is expensed into it. And then on Uber, we're looking at kind of this adjusted EBITDA, not on a per-share basis. So I think investors at these levels with some of these stocks are looking for a little bit more honesty in terms of kind of what's being reported, the quality of the underlying earnings to a certain extent. Your Amazons, your Apples, Microsofts, all those companies report kind of fully GAAP. Everything is run through the income statement, whereas some of their smaller cap peers in technology, get away with the more non-GAAP computation of earnings, which is, obviously not apples to apples. So,
all right.
I think with tech, part of it is definitely a sentiment issue, and then part of it is kind of, I think, just really scrutinizing the quality of some of the actual earnings numbers.